Financial derivatives. Maybe you've heard of this term and you have no idea what actually is a derivative. I'm Clay, let me explain. Quick little history lesson. Financial derivatives really got popular back during 2008 through 2009, 2010, when the big financial bubble popped and real estate market collapsed and all that. So that's kind of when financial derivatives really gained more so notoriety in the headlines and all that. But they've been around for much longer than that. So every now and then, and it's a good question, is okay, so what exactly is a derivative? How does it all work? Well, let's actually just look at the word real quick. And this is pretty much how it all boils down. But what really derivative is saying, and the focal point here is the first part where you have the DER, and this is just representing, actually taken from the word derived. Now derived, that's still kind of, I don't want to say a complicated word, but let's boil that word down even further. And let's just look at derived as more so this right here being, it depends. So that's really the best way to look at derivatives, is something where it depends. Now, of course, we are going to focus on it, and then we'll look at depends. So what depends on it? So the most probably famous and common form of derivative is what are called options, stock options. Now there are other types of derivatives, and anything that falls underneath what we're going to talk about would be considered a derivative. But just for example's sake, let's look at what are known as options. And the way a derivative works is, well, it depends. So two dynamics are occurring in the world of derivatives. We have let's just call it object A, and then over here we have object B. So yes, I'm getting very fancy with the way it all works. But in our situation, object B is actually the derivative, meaning in this situation, this would be the it depends. So this object B has a value. So there is a value associated with it. But what is that value? Well, hey, that's a good question. Well, the value, let's go up to change the colors here. The value is based on, well, the whole philosophy of, well, it depends. Well, it depends on what? Well, it depends on something other than itself. Or in this case situation, it depends on object A. So as object A fluctuates in value, that's what's going to cause object B to actually fluctuate in value. So object B has no value at all if object A does not exist. Because again, it is being derived from object A. It depends on how object A is acting. And how object A is acting is going to cause the value of object B to fluctuate. So let's go back to this whole options example. So in the world of options, what's going on here is we would have a stock. So let's just call it Apple. So a very famous stock out there. AAPL is the ticker symbol. So stock of Apple has a value, and that value is fluctuating up and down, like a stock price does. But there is also things that are derived from Apple stock, such as what would be called Apple options. But the value of the options over here, as far as Apple is concerned, depends on what? Well, hope you're saying, well, Clay, the value of Apple options depends on the value of Apple stock. Exactly. That's what a derivative is. It is an external counterpart to something, and then based on how the main asset works, in this case object A or Apple stock, that is going to dictate the value of the option itself. So in other words, if let's just say Apple stock is doing really, really well and going higher and higher and higher, that is going to cause Apple options to behave in certain ways. But it's going to cause Apple options to behave in the exact opposite ways if Apple stock is going down and down and down and down. So everything is being dictated on here. This, value, if the only reason why this value changes is because of this. There's nothing that this can do over here that's going to influence the stock price of Apple. It all starts here, and then all this flows over here. So what is a derivative? Easiest way to look at it is, well, is this price moving because of something else? I'll go through that again. The question you need to ask yourself is this value changing and moving because of something else? So here is the option of Apple. Is it moving? Is it changing because of something else? Well, yes, it is. It's changing because you have the stock over here of Apple that is changing. Whereas let's run that question through here. Is the stock of Apple changing because of something else? No, it's just changing because, well, it's the stock. But over here, it's being influenced, it's changing because of the stock of Apple. So that is how the derivative market works. Prices, values are being derived from something else. And its value depends on, well, it depends what the value of something else is actually doing. So that is how it all works. And like I said, the easiest way is just, is there any sort of external force that's causing, the asset to actually change in price and value? And if there is, then yeah, it is a derivative because it is being derived from, it depends on something else. But if it can operate totally solely, just like a stock price can, then at that point, it is not a derivative. Another common famous type of derivative would be futures contracts. And I'm not gonna go down all that, but that's the same exact principle. Futures contracts, their value is coming based off of something else in the market. So whenever you hear derivatives, and just one more I started with the history lesson of the financial kind of collapse, and I'll end. The reason why that financial collapse really spun out of control was because there are derivatives in the market that were derived, their value came from being tied to mortgages. And when those mortgages and stuff started to go bad and south and get worse and worse, those derivatives, they did not act like the people wanted them to act. And then that just started a whole domino effect. So the derivatives itself, yes, they were the cause of the problem, but what the true cause, the root of the cause was actually those mortgages all started to go bad. And because those mortgages started to go bad, that was the first domino that affected the derivatives, because remember, it depends on how the mortgages were doing. And when the mortgages started to go bad, those financial derivatives that were attached to them, well, they started to go bad. And then that's what sent the ripple through all the financial markets. But that is how it all works. Any questions or anything, please leave those down below. I realize this can kind of be a bizarre concept, but it all just depends on the value of something else. And if that is what's going on, then you have a derivative that you are dealing with. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.